There's a bombshell report making the rounds that the mainstream media is completely ignoring. It reveals a crack in the economy that, in some ways, is already looking worse than the 2008 financial crisis. The report points to a commercial real estate crash that's setting the stage for what could be a massive wealth wipeout. The numbers are staggering, the implications are frankly terrifying, and today we're going to break down exactly what this means for you. This isn't about hype, it's about data. And some of the data that has emerged is among the most alarming I've reviewed in my entire career. It points to a critical time in our economy, and it's essential to have this conversation now.
Let's get right into it. The core of this issue is a crack in the economy that looks worse than 2008. Most people hear that and think it's impossible, that the system is safer now. But recent 2025 data on commercial mortgage-backed securities paints a very different picture. The data is a flashing red light on the dashboard that almost everyone seems to be ignoring. The headline number is the overall delinquency rate for these commercial loans, which, according to a 2025 Kaplan credit risk report, recently stood at 7.29%. But that number hides the real story. The devil is truly in the details. The real bombshell is in the office sector. Recent figures show the delinquency rate for loans backed by office buildings has soared to an all-time high. To put that in context, during the aftermath of the 2008 Great Financial Crisis, the peak delinquency rate for office loans was lower than it is right now. We have surpassed the worst point of the last great collapse, which actually hit in 2012, and we're still in the early innings of this crisis. It's a record-setting implosion that is actively underway. Worse than the post-2008 peak. That's a stunning statistic. And it's not just an academic number. We're talking about billions of dollars in loans on buildings that are failing. This is happening with such intensity in the office sector because of a perfect storm. First, the pandemic fundamentally broke the business model for office real estate. The shift to hybrid and remote work isn't temporary. It's a permanent structural change. National office vacancy rates are hovering near 20%, with some reports pegging it around 19.4%. In major cities like San Francisco and Seattle, it's significantly higher. You can't pay the mortgage on a 30-story building when a third of it is empty. Landlords are losing tenants, rents are falling, and property values have plummeted. But the real accelerant, the gasoline on the fire, has been interest rates. Many of these properties were financed 5 or 10 years ago when interest rates were near zero, perhaps at 3 or 4%. Now, those loans are coming due, and they have to be refinanced in a world where benchmark rates are much higher. The new loan might cost 7, 8, or even more. So, at the exact same time rental income is falling, the single biggest expense, the mortgage, is set to double. The math just doesn't work. This combination of collapsing demand and spiking costs brings us to what can only be described as a ticking time bomb. At the heart of the issue is the maturity wall, the massive pile of commercial real estate loans scheduled to come due that must be refinanced. In 2025 alone, a staggering $957 billion of these loans will mature. To put that number in perspective, that is nearly triple the 20-year average of about $350 billion per year. It's an unprecedented wave of debt that has to be rolled over in the worst possible environment. Imagine you have a balloon mortgage on your house. For years you've made small payments, but now the whole balance is due. You have to get a new mortgage. But the bank tells you two things. First, because of rising rates, your new monthly payment will be double. And second, because your neighborhood has declined, your house is now worth 30% less than your original loan. Not only do you have to pay more each month, but you also have to find hundreds of thousands of dollars in cash just to get the new loan. That is exactly what thousands of building owners are facing. They can't refinance. They don't have the cash to plug the gap. Their options are to hand the keys to the bank or declare bankruptcy. That's why delinquencies are exploding. A nearly $1 trillion wall of debt hitting a market with falling values and high rates seems mathematically impossible to end well. It's easy to think this is just a problem for big city landlords, but this crisis escapes Wall Street and hits Main Street through the banking system, specifically the regional banks. This is the contagion vector everyone needs to be watching. While the big Wall Street banks offloaded a lot of their risk, the smaller and mid-sized regional banks are the primary lenders for most commercial properties in this country. Analyses show that these commercial real estate loans make up a much larger share of the loan portfolios at regional banks,
over 40% in some estimates, compared to just a fraction of that, around 13%, at the giant too-big-to-fail banks. They are massively overexposed. We saw a preview of this in the spring of 2023 with Signature Bank. While its failure was triggered by a bank run and issues with its uninsured deposits, regulators noted its deep exposure to commercial real estate as a major underlying risk. Now, a recent academic analysis showed that 278 regional banks in America could be vulnerable to failure if they were to experience a loss of just 8% on their CRE loan portfolios. That's from one stress test study, not an official finding, but it shows a razor-thin margin for error. This isn't a theoretical risk, it's an active threat. What this describes is a direct line from empty office towers to the potential failure of the banks where millions of Americans keep their money. It's a silent crisis building just beneath the surface. If you're getting value from this breakdown, and if you think this is information more people need to hear, please take a second to hit that like button and subscribe. It really helps us get this warning out. This banking risk is terrifying, but it isn't happening in a vacuum. There are other red flags that suggest this commercial real estate problem is a symptom of a larger disease. The commercial real estate crisis is part of a negative feedback loop with the wider economy. The warning signs are everywhere. First, look at the labor market. Recent private sector job reports have been softening, with some even showing net job losses. This is critical because it tells us that the demand for office space isn't just low, it's likely to get even lower. Companies that are letting people go don't lease new office floors. This creates a doom loop. A weakening economy leads to job losses, which leads to higher office vacancy, which crushes property values, which then blows back on the banks, forcing them to tighten lending for everyone, which weakens the economy even more. And what about the consumer? For 2 years, we've been told the consumer is strong, but the consumer is cracking. The latest data from the Conference Board on consumer confidence has been shaky, with consumers' expectations for the future remaining deeply pessimistic. They are clearly worried about their future income and job security. They are voting with their wallets. We've seen retail sales numbers come in sluggishly. Once you strip out volatile items and account for inflation, real spending is going down. Surveys have shown a majority of Americans planning to keep holiday spending flat, which is a cut in real terms. People are scared. They feel the weakness, and they are pulling back. Finally, look at the producer side. Lately, we've seen key business inflation measures like the Producer Price Index flatten out, and oil prices have been falling. Commentators will try to spin this as good news. Inflation is beaten. But what it really signals is weakening demand across the economy. Businesses are seeing their orders shrink, so they're paying less for raw materials. It's not a sign of health, it's a sign of sickness. So to summarize, we have a record-setting crash in the office sector that's worse than the post-2008 peak, a nearly $1 trillion wall of debt that may not be able to be refinanced, hundreds of regional banks potentially at risk, and all of this is happening as the job market and the consumer throw in the towel. This feels like the very definition of a systemic crisis. For the average person watching, this is frightening. So what are the practical steps they can take, not to get rich, but to simply get through this? The number one rule in a crisis like this is capital preservation. This is not the time to be a hero. It's time to play defense. While I can't give specific financial advice, I can share some broad principles for consideration. First, you have to review your financial exposure. Look at your 401k, your IRA, your brokerage accounts. Do you own a lot of regional bank stocks or ETFs? Do you have holdings in commercial real estate REITs, especially those focused on offices? Many people own these without even realizing it through broad index funds. Understand what you own and decide if you're comfortable with that risk right now. Second, liquidity is king. Cash is not trash in this environment. It is an asset that provides safety and opportunity. The common advice is a 3 to 6 month emergency fund. Facing this kind of systemic risk, it could be argued that a war chest of 6 to 9 months worth of living expenses is more prudent. This money shouldn't be in the market. It should be in the safest, most liquid places you can find. High-yield savings accounts or short-term U.S. Treasury bills. This ensures your capital is safe and accessible. Third, consider what has historically protected wealth during financial instability. Assets that aren't someone else's liability tend to perform well. For centuries, physical gold has been used as a hedge against systemic banking risk. Owning a small allocation can be a form of insurance against the worst-case scenarios.
It's not about making a profit. It's about preserving purchasing power if the financial system itself comes under severe stress. Review your exposure, build a cash war chest, and consider traditional safe havens. It's about building a financial lifeboat before the storm makes landfall. The picture this data paints is sobering, but necessary. We have a data-driven crisis in commercial real estate, led by an office market collapse that has surpassed the post-2008 peak in severity. And it could be spreading through the regional banking system while the broader economy is slowing. The mainstream media may be ignoring this, but the numbers don't lie. The tremors are getting stronger. I want to ask everyone watching, what are you seeing in your own city? Are the office buildings downtown ghost towns? Are local businesses closing? Share what you're seeing in the comments below. It helps all of us build a more complete picture. For everyone watching, thank you for your time. The goal here isn't to spread fear, but to encourage preparation. Make sure you are subscribed with notifications turned on because we will be tracking this relentlessly. Stay informed, stay vigilant, and we'll see you next time.